even before this downturn, we were seeing a shift in investor behavior relative to those small levered producers, right? The cost of funding had already risen. Now it's a significant hit to cash flow, to balance sheets. The industry will look very different. Those small producers will shrink further, and we finally get the healthy consolidation that we never got in 2016, right? Remember, we went to the low 20s in February 2016, but that was quickly followed by production policies to support price or big fiscal stimulus globally, which just derailed the rebalancing. I think this time around, we will have that healthy rebalancing for the oil sector.
Damien, I'm curious if you agree with what Andy Lipow did say, where he said that OPEC Plus might have to cut production because there's simply nowhere left to put it. I mean, like you said, the storage is going to run out pretty quickly here. Could that force production cuts?
Yeah, so, I think, Kelly, that's a good point. And I'd agree with Andy here is, they are trying to push record exports into a market that is nearing saturation in many places. And, refiners are seeing a drop in demand that, if you look at the U.S. alone for gasoline, maybe as large as 40% this week. They're reducing their runs. They're not going to take incremental barrel because they simply won't have the ability to store it. So I think what looked like initially a very tactical, rational increase in market share at a period of weak demand may actually end up being exactly that, an attempt to put barrels when the world can't take them. Now, it doesn't mean that a sudden reversal in policy, a grand agreement to cut production across countries is sufficient. Right? Even at that point, it's probably too little too late relative to this enormous demand shock we're going through.
Damien, I usually the apocalyptic predictions turn out to be wrong, but I'm curious, are there long-term consequences for what we've come to know as the carbon economy? So much of what we do, whether it's flying, taking a train, driving, socializing, revolves in or touches one way or another on the carbon economy. Are there implications there that we ought to be thinking about?
I mean, it's a good point, right? 16% of oil demand is either people flying or people commuting to work, right? If we see a lasting shift in behaviors from this current experience of isolation, then again, that demand may never return to its previous peak. And if in fact, the rebalancing process by which we shut in production actually creates a more bullish setup later this year, high oil prices may also start to lead to further demand destruction on a structural basis. Mm-hmm. So I think that's a very valid point, and we may, in fact, be accelerating this transition. Now, ultimately, keep in mind, right, again, 2 months ago, we were focused on ESG, on the carbon footprint of energy. That will come back. That's not going away. And in fact, when we will see how much pollution has been reduced through this slowdown in activity, I think it will give a very clear potential pathway to how you can achieve decarbonization, which is just less energy-intensive activity.
All right. Damien, thank you very much. Damien Courvalin is with Goldman Sachs.